Okay, I understand we are live, so I think we can begin this webinar. Just to everybody joining us, just to say welcome. This is the Asset Management Report webinar. My name is Dan Owen Brown. I'm the Director of Market Insights, Data and Analytics at EFAMA. And I'll be your sort of guide for the next hour with interventions from other people you should see on the screen right now, I believe. So today we present the 17th edition of EFAMA's Asset Management Report. It's really an in-depth analysis of trends in the European asset management industry. It looks at where assets are managed with a specific split between investment funds and discretionary mandates. And we publish it once a year, usually around this time towards the end of the year. So today's agenda is a two-part agenda. The report includes 3 boxes. So these are short insights developed by external collaborators on relevant topics for the industry. This year there's 3. There's one on M&A and asset management by Oliver Wyman. There's one on private wealth allocation to private assets by Novantigo. And finally, there's one on agentic AI in asset management by McKinsey and Company. And so actually that's the first thing we will be turning to in this webinar is the insight by McKinsey and Company. There'll be a fireside chat with McKinsey on their insights on agentic AI and asset management. This is roughly 20-25 minutes, and we'll do a Q&A at the end of that. Then we will have a presentation on the main findings of the Asset Management Report, or AMR, as it's internally known, by our EFAMA reports lead. This is roughly 25-30 minutes, also with a Q&A at the end. For both of those 2 sections, you should be able to access the chat on WebEx. So please put any questions you might have in there, and the team will address them at the end of each section. So that's it. I will introduce the speakers for the fireside chat that we have, which is McKinsey, and also Franco Luciano, who works for EFAMA. He joined EFAMA in June 2024. He's a policy advisor with the EFAMA regulatory policy team and is responsible for the work on regulatory issues relating to post-trade activities in capital markets and digital finance regulations such as the AI Act, relevant for today's discussion. We have Maximilian Fiedler, is an engagement manager at McKinsey and Company, who supports financial institutions in technological transformations. His focus is on using artificial intelligence and AI agents to optimize enterprise processes. Before joining McKinsey, he completed his doctorate at the Technical University of Munich on the efficient analysis of very large data sets, with research stays at Stanford University and ETH Zurich. And we also have Caroline Schaumann. She's an engagement manager at McKinsey and Company, also with expertise in supporting leading financial institutions on tech-enabled performance and transformation programs focusing on organizational efficiency and effectiveness. So without further ado, I will pass over to Franco for the fireside chat with McKinsey on agentic AI in asset management.
Thank you very much, Dan. And thank you very much to Max and Caroline to be here with us and for sharing their time and for us to be able to go a bit more into detail on the insight, which is part of the report we're presenting here today. So maybe a few words on the work that EFAMA has been doing on the AI front for the last year. Basically, we have been very active in all of the aspects related to advocacy, of course, with a strong focus on the AI Act. We have been very engaged with the AI Office, trying to support through many responses to consultations relating to the different strategies and the guidelines that have been put forward to offer clarity to market participants in implementing the AI Act. We have also developed the EFAMA AI System Assessment Tool, published in February this year, which seeks to offer a template by which firms, not only from asset management, but from also different sectors and industries, they can take stock of the AI use cases they have in place, and through this be able to meet the requirements under the AI Act and other complementing regulations. And final word on the EFAMA AI system assessment tool. We have been working very actively in the last months to produce the version 2. So stay tuned. It's coming soon in the next couple of weeks, and we hope that it further helps firms to meet the requirements under this very complex framework. But to go straight to the point, well, thank you, Max and Caroline, for this report, which I found very interesting. I thought maybe I could ask the first question to Max. So I would like to take us back to 2023. In that year, EFAMA issued an asset management report in which we also included an analysis of McKinsey. And at that point in time, there was an estimation in that report saying that AI in asset management could enhance productivity by around 7 to 12%, which led to an estimation that this could generate between 2.6 and 4.3 billion euros in added value to the European asset management industry. Now, in the report we're seeing now in 2025, we see that these estimates have been recalibrated, and now the estimation is that the value could be between roughly 25 and 30% across the full value chain. So I wanted to ask you, Max, if you could maybe walk us through this process. How did you arrive to this calibrated outlook?
Yes, thank you so much, and thanks for having us. Maybe I'll start a bit with the underlying, technological changes that have allowed this, and then I'll talk a bit more about the methodology. First of all, on the technological side, there have been two major advancements that allowed this. Right, the first one is advancements in the underlying large language models. Right? So, over the last 2 years, they have advanced a lot. There's a lot of competition in the market, and they have continuously added features such as deep research thinking mode that now allows them to handle much more complex requests and problems. Right? That's first side. And the other element, which is probably even more important, is that these LLMs now get access to tools. Right? What does it mean? Previously, these LLMs were trained on some data set and they could kind of query from that data. Nowadays, they can kind of start using Google, for example, right? But they can also use a company database to request information. They can also write a Python script ad hoc, start running that, or use some design tools. Right? And this access to tools is what kind of allows kind of a paradigm shift in the way we are working, and then also how that boosts the productivity in our report. Previously, and if you think about co-pilots, it was always about boosting individual productivity. So the productivity of the individual person who used the tool to write some text, to structure some information, but essentially still did the work, but just with Gen AI. Now with agents, that changes a lot, where actually agents can do a lot of the work themselves. They can collaborate and produce some output, and then the human becomes more of a reviewer of that kind of work. And in that setting, there's a lot more of automated work that is done by the agents that in the background do a lot of the drafting, and the human becomes more of a feedback giver, allowing much higher productivity estimates. And the way we've kind of then calculated that is we looked at the different elements and use cases in the value chain, assigned them typical, boost productivity. And for many of them, we're also seeing in deployments that will kind of reach a lot higher productivity numbers for those use cases. That then across the value chain brings us to this 25-30% boost in productivity. And even maybe going beyond productivity, with agents doing a lot of the work, we can now also see more opportunities in investment alpha and risk alpha beyond the productivity side.
Mm-hmm. It's very encouraging to hear about the potential of these use cases. I also wanted to point out that you argue in the current analysis that agentic AI actually offers possibilities that go beyond what would be expected originally from generative AI. Could you actually share with us a few concrete examples where you have seen agentic AI being deployed in asset management, and explain how these use cases actually translate into these productivity gains and, as you say, other added value to the chain itself?
Yeah, happy to. I mean, on the productivity side itself, right, the typical problem we always have in asset management is client reporting, right? It's highly manual work. There's a lot of fragmented processes, and now with agents, how would that look like? You would set up multiple agents that do the work in the background, and becoming quite tangibly, you, for example, would set up a knowledge collection agent, right? This agent would then pull portfolio data, would pull benchmarks, risk data, market data, etc., and ensure that we have the right knowledge on the right data for the report. And would then pass that information on to something you could call an analytics agent, right? That might run a couple of analyses on that. And it doesn't mean this agent needs to come up with those analyses. It could just mean the agent just triggers the analysis that you've always been doing in the background, using that tool access, and just run them with the existing scripts that you have. Take that output and then pass it on, for example, to a reporting drafting agent that then takes all that information, structures the information, but then also tailors it, for example, right, in the structure, in the tone and language that is needed for the specific report. And then what we also typically see in such setup is that you will have like a QA agent that will take that output and already provide some initial feedback to those agents to have an internal automated review mechanism. And then after that is then you would pass that first draft of the report to human to get this human in the loop element in here, ensure things are correct. Right? The agents might have already flagged a couple of elements that the human needs to review. And then the human can do the final sign-off, can modify the report, but also provide additional input to the agents that then might need to run this process again. Right? And that's kind of how you would set up an agentified client reporting use case in the backup. Right? And I mean, other ideas, we talked about this, the investment alpha, right? For idea generation, investment idea generation, you could use a similar principle in the background, collect all the needed information, and then have or point the analysts and portfolio managers to those opportunities that are aligned obviously with company guidelines, but also most promising, and that then will also improve ideally the quality of the output of the investment decisions and not just increase the productivity.
That's very interesting to hear. Thank you. I thought maybe we could turn to Caroline now. And what I wanted to ask you is that although the potential gains are substantial, as we were just hearing, I noticed from your report that you point out to the fact that very few asset managers have so far achieved even more than 5% in terms of cost efficiencies. Now, I'm sure you're very involved with the industry, so based on these interactions, I wanted to ask you if you could share what are the main obstacles that you have perceived at the moment that are preventing firms from fully unlocking the potential of AI. And if you could also, from your point of view, share with us if you consider these challenges to be mainly coming from the technology, the organizational, or the regulatory aspects that a company usually has to address.
Sure. So I think it's a mix of the things you mentioned. So we have industry specific challenges we are facing due to process landscapes which are fragmented, or we have a lot of outsourcing tasks, for example, in the back office function, which prevent end-to-end automation due to the dependencies we have, for example, to third parties. We have also we see often tech legacy or tech process legacies, which may prevent also the agentic AI applications, since you have not compatible IT or tech stacks which you can use, or where you may need to build up interlayers for data processing, We have also vendor lock-in effects, for example, processing external data, market data, which you want to use for agents. Or you have also fragmented data landscapes or manual processes, since still a lot of tasks are also done by paper or manual file processing, which is not that easy to integrate in these agents, or they have to be done a lot of pre-work, which prevents like capturing the effect from the beginning. But what we also see is, which also limits the value capture, is that there's a primary focus when you implement AI on horizontal use cases, as Max already mentioned before, like providing tools like Copilot or the enterprise GPTs, facilitating the work of the individual, but not focusing on specific tasks in business domains. So what we recommend is really to focus more on vertical use cases, where you have a deep look in a specific business domain and try to build a chain of different agents to automate as much as you can, still with the human in the loop. And the second thing we see is the scalability theme. So it is quite easy to build one or two agents relatively quickly. Which is more challenging is to build up a structure where you can really scale these agents across different business units or along the value chain. And this is, I think, one major challenge you have to face, as you have to build up like an agent library which you can use, which then also allows the interconnectivity between these agents, and that you not come up with silo solutions where you spend a lot of time and also money for the investments in, which is then not usable for the rest of the organization. So this would be the explanation about why the value capture is not yet that large. But we see the theoretical value, we see, and we see also that the part of value capturing is definitely increasing.
Mm-hmm. Yeah, and I really appreciate this conceptualization around AI being integrated horizontally and vertically across organizations. I think it really helps firms consider how they actually need to restructure to enable AI to unlock this potential. And maybe one final question before we turn to the Q&A segment and we start taking some of the questions from the public, which they can share through the chat function at WebEx. So I wanted to ask you about a point raised in the report, which is that agentic AI is not just a technological upgrade, but it's also a broader transformation that requires a new target operating model. And in many cases, it requires that the overall strategy of the firm to be rethinked. Could you maybe describe some of these key changes that you consider asset managers need to make to their target operating model in order to unlock the potential of AI within their value proposition?
Yes, sure. So when you decide to adopt agentic AI or in general Gen AI, it is important that you in the first step define an AI vision. So the vision should be aligned with the overall, as you said, company strategy and also value proposition. And it should clearly state the purpose behind why you want to integrate and adopt agentic AI. And this vision should also have also a positive connotation about how agents can really empower client services and a quality of work to anchor your transformation effort before you start with shaping the target operating model or processes. Then for the second step you have to do is really to build an understanding about the end-to-end process landscape. So to understand which different kinds of tasks you have across the organization, and then to build business, we call domains based on similarity or related content, which allows you at the end to build agents and scale these agents within these business domains to realize faster impact. And these business domains vary also in the AI potential. So if you perceive it from the expected efficiency outcome, but also if you have a look on the technical feasibility, how you can apply agents in these business domains, which allows you then to really prioritize where do you want to put effort in, and which are business functions you may, or business domains you may not want to address in the beginning. And if you have done this, you can start with setting up the right target model, the target operating model for this transformation by redefining the roles and responsibilities which are needed. You need to come up with a new org setup, how the teams are cooperating with each other, but also then providing the accurate tech stack and data infrastructure to enable this. And maybe to go a little bit more in the detail of the first part, like the roles and responsibilities and the org setup, there we notice, like, if you start with the agentic transformations, the profiles of course shift a little bit more to the technical part. So you need more data architects, software engineers to really build these agents, both at the beginning of the transformation, but also later on if you want to maintain and improve the agents when you get like better in the processes. And then you have also to think about how to integrate the business and technology teams, because it's really important that you bring both sides together at the beginning to ensure that all agents which will be built really address the business needs and are not perfect technical solutions which then not really bring the value you're aiming for. And then, of course, based on the new setups, there are shifts in the organizational model. To think about new committee structures. How do you want to manage risk? How do you prioritize agents across the organizations? Where do you want to invest in? Which then results in also new reporting lines which need to shift. So these AI transformations have then a more larger impact than just building individual use cases you want to implement.
Thank you very much, and I'm sure our public is really interested in everything they have heard so far, both about the potential value that AI could bring to your organization, but about the bold transformations that are required to truly enable this technology to deliver the results and the goals that we are looking after. So I think this closes the fireside segment of our chat. But maybe we could turn to the audience. I think we have maybe 5 minutes to take questions. So at this time, I think we can. I think the chat function is enabled, and if anybody has any questions they would like to ask, either to Max or to Caroline, and this is the time to go for it. Thomas, Dan, do you see any questions from your side?
I don't think we seem to have any questions from the chat, so maybe we can we might move on from the fireside chat. We could, if anyone wants to be in contact with us or else McKinsey on this topic, I'd encourage. We do have somebody raising their hands, but if you'd like to put your question in the chat, we can address that.
I believe it leaves me. I cannot type in the chat. I'm not sure about the participants.
Okay,
Yeah,
we might have a.
I seem to see that it says public chat is off, so maybe we should enable it.
Yeah, I'm not exactly sure how to do that. If our admin might be able to enable that. Okay. We might need to, I'm not exactly sure how to enable that, I'm afraid. The settings have been changed. We can see if there was a question, otherwise we might need to move on. But as I was saying, if anyone in the webinar wants to contact us, either EFAMA or McKinsey, that would be perfectly fine on this topic. I'm sure they'd be willing to see with you what can be done, and also on our side, you can contact us.
Yes, feel free to contact us. Happy to take any other questions after this.
Okay. I think we might need to move on from that, if that's okay. If some things do come up, we could potentially address them a little bit later. But given time, maybe we can move on to the second part of the webinar, which is a presentation of the main findings of the asset management report. So here we have Thomas Tilley, senior economist at EFAMA. He's been with us since June 2017. He's a senior economist with a focus on research topics related to the fund and asset industry. He closely follows market developments in the industry, and handily, actually, he's the main author of the asset management report, which is great. He has an extensive background in central banking and macroeconomic statistics at the ECB and the Belgian National Bank. So we will go through the presentation that he's prepared and that you should see on the screen right now. And I hand over to Thomas to take us through the overview of the findings from our latest report.
Thank you, Dan. Yes, so our asset management report. The overview, the outline of the presentation is, we'll give a little bit of an introduction on what the report is, then we'll go over what the amounts are of the assets under management in Europe. We go a bit deeper on the role of asset managers in society and how they are financing the economy. We discuss the clients, asset allocation, and then the industry organization. So, as Dan mentioned, the point of view of this report is where assets are managed in which country, regardless of the country of fund ownership or fund domicile. So that's a bit of a different perspective from our usual reports, our monthly fact sheets, our quarterly reports, and our fact book. So it's actually quite a unique perspective. There are not no other publications out there with this perspective. The data is based on data collected by our national associations, 19 national associations. And then we do have these perspectives, these external perspectives by three external contributors. I won't go into them again. Here we look at how AUM, assets under management in Europe, has evolved over those past few years. And we see here that going from 23 and 23 to 24, so the bulk of the data is based on data that was recorded at the end of 2024. We have an increase of about 11.7%, which is quite a solid increase. This was a lot due to the strong performance of stock markets. The Euro Stock Equity Index had a return of about 12%. The MSCI World Index increased by 19 and a bit percent. So this was a strong performance. It was hampered a bit by the low increase in bond prices. There was only a 1.9% increase in bond prices. So those price evolutions are here shown on the right-hand side. We do make some estimations on what the AUM will be in 2025. So we have an estimate of end of September 2025. So growth appears to continue throughout 2025, but we come to only a growth of about 4.2%, which you could say is a little surprising, given that stock markets actually performed quite well so far. There was a bit of a stutter in Q2, but overall, like the Euro Stock again returned 12.8% over the first 9 months of the year. MSCI World 17.8%. So why was this growth only 4.2%? Well, first off, there was all the tariff turmoil, which sort of spooked investors a little, meaning we had less inflows. And then there was a sharp depreciation of the dollar versus the euro. And this has an impact because European investment funds, asset managers invest a fair bit in US equity, and the US stock market did well, but the dollar appreciated between 11 and 12% over that period. So that depreciation, of course, gets then factored in the growth here, which is measured in euro. And then also another component was the zero growth in European bond prices. So let's see how that will continue the last quarter of the year, but we don't expect to get to a very high number here. Then, in which countries is this asset management taking place? It's quite concentrated. This is sort of data we've been showing for a few years now. There are about 6 countries in Europe where 85% of asset and fund management is taking place. The UK is the largest market, followed by France, Switzerland, Germany, Netherlands, and Italy. But then we also have some asset management taking place in some other countries. And here at the end, I point out what we call the rest of Europe. These are the countries for which we don't have this survey data, and for whom we make sort of an estimation based on external and internal sources. This is notably Sweden, which is a rather big market, then Finland, Norway as well, and then also the 2 cross-border fund domiciles, Luxembourg and Ireland. Even though they don't do a lot of day-to-day asset management there, some is taking place, so we make an estimation there, and we get to about slightly below 9%. Breaking this down, you have 2 main ways how asset managers manage assets, either investment funds or discretionary mandates, so explicit mandates given by a client to an asset manager. At the moment, this split between mandates and funds is about 42 to 58%. 10 years ago, it was about 50-50. So we've seen a steady rise in the share of funds and a steady decline in the share of mandates. Of course, this doesn't mean the actual assets in mandates has gone down. It just means that funds have grown stronger. Why have they gone stronger? You have a higher share of equity in funds. It's about listed equities, listed stocks account for about 44% in the fund market, and only 26% in the mandate. And given the strong performance of the stock market, this has seen solid growth. We had only 1 year where we had a decline in 19, and that was more due to a statistical reclassification. So stronger growth in the funds than in the mandates. If we look at in which countries the funds are being managed, geographically speaking, UK is the largest market, then followed by France, Germany, Switzerland. The big markets here, which have grown in market share and which have declined a bit. UK has increased in market share, mainly again because UK funds tend to have a slightly higher exposure to equity than some other funds. Germany has declined a little here. This is mainly due to some re-internalizations of funds, of these special funds. But a big decline here was in the Netherlands, and this is because the big pension fund market in the Netherlands is often structured with pension funds, entire pension funds having an AIF wrapper. And with when the new prudential rules, IFR, IFD, sorry, I always mix these up, came into play, it was actually more advantageous in terms of capital requirements for asset managers to switch those fund wrappers into mandates. So we had sort of a big reclassification. Those assets didn't disappear, they just got shifted to mandates. Because if we look here at the mandate market, the Netherlands here saw a strong increase. For the rest, this market, the mandates is even more concentrated, with the UK accounting for 45%, and then France at 13. Germany a lot smaller there, since in the fund market they're often it depends a bit locally how your market is structured. In Germany, for example, institutional investors mainly invest in these Spezialfonds, these particular AIFs that are targeted at institutional investors, whereas in Italy you have a lot more use of mandates, for example. Turning now to the role of asset managers in society and in the economy. We had a look at what the funding contribution is of investment funds and other investors to the economy in terms of listed shares. So if we take all the shares that are issued in, this is the euro area, since the data it comes from the ECB. So all the shares issued in the euro area, we can break this down. About 43% is actually owned by non-euro area investors. This is we don't have a breakdown there, but these are investors. This can be all types of investors, retail, institutional, whatever, and they're based in the UK, they're based in the US. So this is a pretty large percent. The rest, 57%, are euro area investors, and breaking those down, we have mainly non-financial corporations, so companies owning other companies, and then investment funds account for 14.5%. So they're actually the third largest owner of listed shares that are issued in the euro area. More than households, so more than retail investors are owning directly. This share has slowly edged down in the past years, since 2021, and that is because actually all types of domestic euro area investors have seen the share of funds of shares they own edge down, because the foreign investment has crept up, showing how sort of international and integrated the market for listed shares is. Of course, this only means, so euro area investment funds own 1.4 trillion in euro issued stocks, but they also own a very large share and very large amounts of shares that are not issued in the euro area. About 70% of the listed equity holdings of euro area investment funds are outside of the euro area, mainly in the US. If we look at the bond market, we have a completely different picture. Here, euro area investors are much more prominent. About 3/4 of all bonds that are issued in the euro area are owned by local domestic investors. Here, the role of the central bank, the ECB, comes quite apparent. In their quantitative easing program, they bought vast amounts of bonds, which I mean, they stopped the purchases of bonds, but they're only slowly building that down now. So now they still account for about 18% of all ownership. Commercial banks also own 15% of all bonds issued, mainly because they invest a lot in short-term bonds. And then investment funds account for about 15%, and this share has actually been increasing. In the report, you can also see, we can break this down between government bonds and corporate bonds. And actually, if you look at the corporate bonds, investment funds own about almost 21%. So they're a very large investor in corporate bond, showing how the industry and investment funds are actually financing European companies. If we then expand this analysis a little bit, trying to estimate the overall funding of what our industry, the asset management industry, means for the European economy, we add the investments in discretionary mandate. So these figures here are just funds, but we add the mandate figures. And we also add EU investment funds domiciled outside the euro area, so domiciled in Sweden, Poland, and those other countries. That's compared to the denominator of all bonds and stocks issued in the EU, not just the euro area. We get that about 6.8, this should be, so 6.8 trillion is the amount held by European asset managers. This corresponds to about 28% of the total bonds that are issued in the euro area. For shares, this is about 2.8 trillion, which corresponds to about 24%. This really proves how the substantial contribution the industry, asset managers make to financing the real economy. The client there, so this shows the market share of the individual clients. You have, let's call them two main clients, retail clients and institutional clients. So the big institutional clients we can mainly break down in pension funds, insurers, and other institutional. These others are endowments, holding companies, foundations, NGOs, sort of this other bracket. We see this steady rise in retail investing, really quite striking. And if you look here on the right-hand side, you see the actual AUM asset growth by client type. Over the past 5 years, we had consistently higher AUM growth in retail clients than in institutional clients. So what is driving this surge in retail investing? It started in the pandemic when, with the lockdown, investors had money that they couldn't spend. So they started to save and started to look into how they can save it, starting to invest it then. 2022 also played a big role. You had this surge in inflation and banks were sort of reluctant to raise interest rates. So investors started looking for other ways to make actual real returns, and they turned to the stock markets and mainly to investment funds. There is also the rise of online platforms and sort of influencers. These are often targeted at young people, and it's an ease of access. You can easily invest money there. So that also played a role. And if you look at sort of the instrument of choice of those retail investors, then by and large, this tends to be ETFs, exchange traded funds. We don't have direct, actual, comprehensive data on how much of ETFs are retail and how much are institutional, but we have some anecdotal data here. For example, there is this study by the French supervisor, the IMF, saying that in 2023, there were about 300,000 French investors that owned an ETF, and in 2025, about 500,000 owned ETFs. So there is a strong rise. There is also this massive increase in ETF saving plans, mainly in Germany, but also in Spain, Austria, Denmark, Italy. So that explains the strong rise. In the institutional market, we have actually this sort of dip here in pension funds. And if you look at it in actual AUM, there was actually a decline in pension fund assets. This was driven mainly by developments in the UK, because UK pension fund industry grew a lot with auto-enrollment in their pension system, but a lot of these defined benefit schemes have matured and got then transferred to insurance. The line sometimes between insurance and pension funds is a bit blurred. For example, like a unit-linked pension funds would sometimes then be labeled as insurance. So it's not always super clear what's pension funds and what's an insurer client here. Another interesting development is the steady increase of foreign clients. So these are clients of the industry based in a different country than where the management is taking place. So Italian clients having their assets managed by a German asset manager or so forth. This also has been steadily rising, showing that at least here we are reaching a goal of the Saving and Investments Union, mainly like the integration of the European national capital markets into a single unified European capital market. This was driven also by a country not in the EU, by the UK, which is increasing their share of foreign clients. They have now more foreign clients than they have domestic clients. But it's not just there. Also, some of the other big markets, Switzerland, France, Italy, all saw their market share of foreign clients increase over 2024. So that's an encouraging sign there. Foreign clients are also a bit more prevalent in the mandates market and in the fund market. That is because the mandate market is mainly focused on institutional clients for whom it's a lot easier to look for asset management abroad than sometimes for retail clients. Moving into the asset allocation, we see here, so this is the market share by the main 4 types of assets asset managers invest in. So equity, bonds, cash and money market instruments, and sort of these other are more the illiquid segments of the market, private equity, private debt, infrastructure, so forth. It also covers a bit of a bracket of we don't know. So sometimes it's a bit unclear what's in there. But what we see from going from 23 to 24 is a massive surge in the equity share. It grew by about 3.7 percentage points, and in actual AUM, it grew by about 24.4%, so stronger than stock markets increased, meaning that we also had investor inflows on top of the market appreciation. This was driven by the double-digit gains of most stock market indices. On the other hand, bonds and money market instrument cash stayed broadly stable. We did see pretty decent increases in terms of AUM, about 11.7%, and here for cash money market, an 8.8% increase, which is quite striking since normally the market effects here place less. But this is related to another trend we've been seeing, is that we had record inflows in money market funds in 2024. We had about 226 billion of inflows in 2024. And that was then again driven by very attractive interest rates, short-term interest rates. You actually had an inverted yield curve for much of 2024, meaning shorter term debt was higher yielding than longer term debt. And it also means probably that some investors took sort of a wait and see attitude in period of quite some geopolitical turmoil. What did edge down significantly is the other assets. And we actually see a decrease here of about 4.5%. It's a bit of a mix of factors behind this. There was a strong decrease in the UK in this liability-driven investment, so these heavy derivatives-built investments, which were sort of still damaged by the gilt market crisis in 2022. There is lower interest in private markets. So no less interest, but lower growth, let's call it like that. And also we have a combination of better data collection in some countries, meaning that assets that were labeled as other because they didn't know now get probably labeled as bond or equity. So the combination of those three effects resulted in this decline here. Another trend we see is the unstoppable growth in passive investing. It's growing every year, and we really see from 2023 onwards, it's been increasing even stronger. It grew about, from 16.8% in 23 to 18.2% in 2025. This again aligns with the popularity of ETFs, which are mainly these passive index tracking instruments. At the moment, we have active ETFs rising strongly, but they come from a very small base, so it will take a while. What are the drivers there? Lower costs, liquidity, ease of access. This is sort of a trend that will continue for a bit. In the US now, the active passive split is about 50-50. I think actually passive now is slightly larger than active. So I don't know if we'll get there, but there is room still for the passive share to increase more. Then we also have data on how much of this asset allocation is held in domestic equity and domestic bonds. Meaning, for example, how much are Belgian asset managers holding in stocks that were issued in Belgium, or Greek asset managers in bonds that were issued in Greece. This has been steadily declining, as I mentioned earlier. It's related also to, especially in the equity market, to the rise of ETFs, and a lot of these ETFs are being funneled into these global index trackers, which are heavily tilted toward the US. I think the MSCI World is now weighted 70% in US equity. So that's related. There are big differences across countries there, with the highest share of domestic equity being in countries like Greece, Eastern European countries, Turkey as well. And this is often because there is less interest in their domestic stock from global asset managers. So their local asset managers have a comparative advantage. And also, like in a country like Turkey, it's less easy for investors there are regulatory hurdles to take your money abroad. There are exchange rates effect that come into play, so that also plays a role. And there is sort of a home bias also, but the home bias is even stronger in the bond segment, where we also see a very small decline in sort of domestic holdings. We had an uptick in 2023 when interest rates had shot up in 22, so these domestic bonds became more interesting in 23, but sort of the downward trend is sort of continuing here. So let's turn to the last segment here, industry organization. Revenues, cost and profit margins. So last year we already noted it. The profit margins, in terms of revenue margins minus cost margins, have actually dropped sharply in 22 and 23 due to a combination of fee pressures, fee pressures impacting the revenue margin. So and at the same time rising costs. And this sort of resulted in profit margins being at 11.1 basis points of AUM, which was the lowest since the financial crisis in 2008. 2024 saw a small recovery of profit margins, mainly because revenue margins stayed more or less equal, but cost margins declined because they are expressed as a percentage of AUM, and we had actually decent asset growth that year. On the right, we zoom in a bit more on the costs. So this is related to the earlier segment, how much asset managers are spending on technology. And we see that this has been steadily rising every year because of the ever increasing investments asset managers need to do in new technology, AI, data centers, that they need to remain competitive. One point I could highlight here is the costs in market data that have almost doubled since 2020, and this is the very high costs in ESG data that asset managers need to pay, but also in exchange data, for example, which means that the consolidated tape will be quite welcome. Lastly, we turn to the employment in the industry. So using our figures reported by our associations and some other sources, we estimate about 131,000 employees that are working for asset management companies across Europe. If we include a number of indirect jobs this generates, so that means across services that are typically outsourced by asset managers, audit, IT, legal, and also the jobs generated by fund distribution, which in a lot of countries is done by banks or financial advisors. We get another about 469,000. So in total, roughly across Europe, we have 600,000 full-time equivalent jobs for the industry, which is a decent size. And of course, this is saying these are direct jobs created by industry. This has nothing to do with how we are financing the economy and in the companies the industry is investing in, which are indirectly contributing to millions of jobs. I think that's all I wanted to share. Maybe let's go to some questions then.
Yeah, thanks, Thomas. Just a reminder, any questions you can put in the chat. There is one that came up. I think it was in regards, Thomas, to your slide 6 when you were showing country breakdowns. The question literally just says Luxembourg ?
Yeah,
so I'm
it's included here in the rest of Europe. We don't have data for how much assets are managed in Luxembourg. We have some estimation, and it's included in this 2.9 trillion here.
perfect. There's one other. It's around expected future trends. I'm not sure we can answer this, but I think it's around how long are we expecting trends to continue for? For example, the change in assets under management of funds versus mandates, the move to passive, which was mentioned, and the increase in retail participation. Go ahead.
It's always hard to look at the future there, but I do think in the next few years, all of those trends should continue because we see them all. They're all sort of related. Funds have a higher share of equity, and that tends to grow stronger. I mean, provided we don't get a massive crash of the stock markets when the AI bubble burst. I can't predict the future there. But that in turn means that there will be increased interest from retail investors in ETFs. So retail will continue increasing, and that means passive will continue to increase. So I think the next few years we can expect these trends to continue for sure.
We just had another one. It's quite interesting. It's more of an observation, actually, as stated. It says, despite Brexit, the UK appears to remain the main asset management place. Do we have a view on that, or anything you'd like to add in?
I mean, you can't deny the data, right? It remains the largest, and in the fund market, actually, it has still increased its market share. Like I say, this is partly related to the higher exposure to equity, but they remain the main fund hub in Europe despite Brexit, and half of the clients in the UK are foreign clients, so they remain the main asset management hub in Europe, no question.
Perfect. Just looking at the hour, I think that's about all we have time for, really. I'd like to thank all of the speakers today, so Thomas, but also McKinsey and Franco for their time on agentic AI earlier. Really, if you have any further questions, please do not hesitate to get in touch with the research team, and we can try to direct you to the relevant person. And yeah, I really encourage you to review the report. This was just an overview from Thomas, and the McKinsey insight is also very detailed. So I think you'll find it interesting to spend some time on that. It should be available now on the website. I saw it was actually published just before we began. So you should be able to get it already. So that's it from us. Thank you very much, everyone, for attending. Have a wonderful end of year. Thank you to the speakers again, and we'll see you some unspecified future. Thank you very much.
Thank you
Goodbye.
very much. Bye.